false perception that consumption is good, and then what you also had is all these LLCs and limited liability companies forming, and these business structures were then they would limited liability, basically, that if something went wrong, you weren't liable. So the risk again was deferred onto something else, another legal entity. So you're not responsible for the bad malinvestments, and no one could really tie down who is responsible. Large accounting profits appear in the capital goods sector. Talk about non-financial profits in the U.S. increased by 65%. This is in contrast. Let me review that first. Like, I have these Meritage Homes, CTEX Corporation. All these companies build homes. There's like a huge surplus of homes in the United States. Like, we have no housing issues right now. Okay. Right now, everyone who purchased a home in this period of time is at first they paid too much, and a lot of them remortgaged their homes, and now they owe too much. There's people who bought a home for $300,000 but owe $1.5 million because they remortgaged their home so many times over and over again. So how is a $300,000 home worth $1.5 million? Doesn't make any sense. So what we're experiencing now is a releveraging of many of these bad debts. So that's why housing prices are going to be falling now back to a good level. Let's see. Point 8 is that at some point the rate of growth in credit expansion ceases, interest rate climbs, and the stock market crashes. As we know, historically, like, you can only expand credit so much because it's going to be worthless at some point because there's no foundation. The business cycle, the government would have you believe that it can correct the business cycle with interest rates by inflating or decreasing the monetary supply. However, the problem with the government is there's a lag time when the government can actually assess what's happening and when it can apply the remedy. And usually, like as in the case of 2001, 2002, by the time the government gets involved, it's already too late. So it's going to inflate, and it's going to drive it up, and then it's going to say, oh my gosh, we put too much in it. Sometimes it'll deflate. In the case of the Great Depression, there was a deflation, took so much money out, then you have a crash. And so when you have these boom-bust cycles, it's only because the government creates a boom-bust phase. It's not because there's any kind of, sometimes I hear, oh, it's because prices are increasing or because of production. These are causing this is what causes the boom-bust cycle, but it's actually not. The boom-bust cycle is caused by monetary policy at the Federal Reserve, and it's just because there's a lag period and it can't correct it in time, and so we suffer a greater depression, recession than you would if it would just correct itself normally. One of the things we also see is point number 9 here: consumer goods prices grow faster than wages in relative terms. According to the United States, now this is the U.S. figure, that 2.3% inflation rate. I think it's more around 10%. 2.3% was the inflation rate between 2000 and 2006. Even if that were correct, wages per hour increased an average of only 1.9%. So inflation increased more than wages. So there's a disparity there. People aren't earning enough money to pay for the cost of goods. A good example of that is college tuition, which has risen dramatically in the past decade, but it's not in line with the real wages of what people are earning. So students are having to pay more, borrowing more money. So point 11, the capital goods sector sustains heavy accounting losses. This again, the companies that are listed here are the same construction companies as before, and we see that because, of course, they can't build homes at that same rate anymore. There's an over surplus of homes that have an overinflated cost. So they have all these, and these companies themselves have expanded their own credit, their own bad debt. So they have bills to pay, and they can't afford to pay them because people aren't willing to pay them anymore to build homes because there's too much surplus of housing. So that's when you see housing companies go down. That's when you see construction companies going down as far as stock market things are concerned. You also see 0.12 workers are laid off in capital goods industries, which was actually a marginal drop, which is 6.72 to 6.7%. And the last issue here is bank defaults mount. Marginally less solvent banks face serious difficulties, and this is where you have the credit crunch. Somebody, I don't remember who it was, but somebody was telling me about how actually everyone's saying how the sub-mortgage issue is the primary reason for this current crisis. And what has happened is when these bad debts started to become insolvent, companies were beginning to repackage them and selling them on the stock market and trading them. And they were betting on these debts, like, oh, what's the risk of this debt? Is this AAA? What's the rating on this debt? And then they were trading them, selling them on the stock market, back and forth. So this kept the credit expansion going. But eventually these bad debts that were resold and repackaged, or again, they were worthless. They were just created out of nothing, just to trade on the stock market. So what I have here, non-performing. So these non-performing loans went up 14% in 2007. These subprime mortgages, which are loans that people just had bad credit, couldn't afford them. They weren't earning enough money, things like that. So the government comes in. Recently, we know that there's a bunch of bailouts that were occurring. And I don't even know what the number is anymore. Like probably near $1 trillion somewhere. So the problem was that, well, the reason the bailouts were coming, there were more bailouts than the initial bailout, is because they said, oh, the banking institutions aren't lending out the money. They're not giving the money putting the money into the economy. So why is that? Well, people failed to notice that when you lower the interest rates, individual banks aren't going to loan out money to individuals at that low of an interest rate because it's too much of a risk. But the Federal Reserve does give banks who hold reserves at the central bank interest on their reserves. So banks don't want to lend out that money because they're earning more interest on keeping the money in the Federal Reserve. So there's the whole reason why banks aren't spending the money or aren't giving the money out to individuals or to businesses. So it's less risky for them, and they're earning a great interest rate. So the government, I think, failed to see that, and they said, well, we have to lower the interest rate more and more and more. We have to give them more bailout money. But it was counter-cyclical. It created more freezes on credit, in my opinion. So if I had to sum it into a root cause, which I put root cause, we face a credit crunch stemming from the creation of bad debt by the banking system. And I know it's a very complicated topic, so I'm hoping, in the question and answer, we can flesh out more details on that to get into more specifics. But essentially, this credit created bad malinvestment, which created a credit boom. And when these bad credits had to be re-leveraged, that's when you have the bust phase of the business cycle. Let's see. So market-based solutions. I have 6. One is zero government intervention. I think the government should do nothing. It can't. And I have a list of things that it shouldn't do. It shouldn't do bailouts. no monetary expansion. It shouldn't run a deficit.